Welcome to the things that bother me. This channel is about the gap between what the numbers tell us and what people are actually living. In this video, we're breaking down the K-shaped economy of the United States, an economy where growth moves in two directions at the same time, one for those who own assets, another for those who live on wages. We'll look at who's really doing the spending, why the top 10% now carry a massive share of the economy, and how aggregate growth can hide widespread strain. This isn't about politics, it's about structure. If the economy feels strong on paper but fragile in real life, this is why. The K-shaped economy of the United States, a structural assessment of divergence, power concentration, and economic stratification. The illusion of a single economy, the United States does not have one economy. That idea, repeated in headlines, political speeches, and quarterly earnings calls, is no longer accurate and arguably never was. What exists now is a bifurcated system, operating under a single national banner. One economy accelerating upward with velocity, insulation, and institutional protection, and another drifting downward or stagnating under rising costs, fragile employment, and declining leverage. The term K-shaped economy is often presented as a temporary condition, a short-term distortion caused by a crisis. That framing is incorrect. What the U.S. is experiencing is not a momentary divergence, but the visible manifestation of structural design choices made over decades. Choices regarding labor valuation, capital preference, globalization, technological adoption, and policy asymmetry. In a K-shaped economy, aggregate statistics lie by omission. GDP growth can be strong while millions fall behind. Stock indices can surge while household balance sheets weaken. Employment numbers can improve while job quality deteriorates. These contradictions are not bugs in the data. They are the defining features of the system. This report examines how the K-shaped economy formed, who occupies each arm of the K, how institutions reinforce the divide, and why conventional recovery narratives fail to describe lived reality for a majority of Americans. 1. Defining the K-shaped economy. A K-shaped economy describes a recovery or growth pattern in which different segments of the population experience sharply divergent outcomes. The upward arm of the K includes asset holders, high-income professionals, capital-intensive firms, and industries tied to financial markets, technology, and intellectual property. The downward arm of the K includes low to middle-income workers, service sector labor, small businesses, renters, and individuals dependent on wage income rather than asset appreciation. Unlike a V, U, or L-shaped recovery, a K-shaped economy does not imply a shared trajectory over time. The gap widens as growth itself becomes a mechanism of separation. This is not merely inequality. It is economic decoupling. 2. Historical roots. The long setup before the split, the K-shaped economy did not begin with COVID-19. The pandemic revealed it, policy responses accelerated it. The groundwork was laid across several decades. 1. Financialization of the U.S. economy. Beginning in the late 1970s, profit increasingly shifted from production to finance. Returns on capital outpaced returns on labor, and wealth accumulation became less tied to work and more tied to asset ownership. 2. Wage stagnation versus productivity growth. Since the early 1980s, worker productivity continued to rise while real wages for the median worker largely stagnated. The surplus value flowed upward, not outward. 3. Policy asymmetry. Monetary policy consistently intervened to stabilize markets and asset prices, while labor markets were allowed to self-correct. Institutions such as the Federal Reserve became more responsive to financial stress than to wage erosion. 4. Globalization without labor parity. Global supply chains lowered consumer prices, but hollowed out domestic manufacturing power, reducing bargaining leverage for large segments of the workforce. By the time the 2020s arrived, the economy was already primed to split. 3. The pandemic as an economic accelerator, not a cause. COVID-19 did not create the K-shape, it locked it in. Upward arm outcomes. Asset prices, equities, real estate surged due to liquidity injections. Remote-capable professionals retained income and gained flexibility. Large corporations consolidated market share. Wealth concentration increased sharply. Downward arm outcomes. Service workers faced layoffs, unstable hours, or exposure risk. Small businesses closed at historic rates. Renters absorbed housing inflation without equity offset. Inflation outpaced wage growth for essential workers. Emergency policy stabilized markets, not households. Trillions flowed through financial channels faster than through wage channels, reinforcing the split. 4. Labor market fragmentation, headline employment statistics, obscure structural fractures. Job quantity versus job quality. While unemployment rates may appear healthy, job quality has declined. Growth in part-time, temporary, and gig work, reduced benefits and schedule predictability, lower bargaining power. Sectoral divergence, high-skill, credentialed sectors, recovered rapidly. In-person service sectors remained volatile. Automation replaced low-leverage roles. Data from the Bureau of Labor Statistics shows that wage growth at the bottom lags far behind inflation-adjusted cost increases, particularly in housing and healthcare. 5. Asset inflation versus cost inflation. Two different realities. One of the defining features of the K-shaped economy is asymmetric inflation. Asset inflation, stocks, housing benefits owners. Cost inflation, rent, food, insurance punishes non-owners. For those on the upward arm, inflation can be neutral or even positive. For those on the downward arm, it functions as a regressive tax. This creates a feedback loop. Asset owners gain equity and leverage. Non-owners fall further from entry points. Intergenerational mobility declines. 6. Housing as the primary divider. Housing is no longer just shelter. It is the main sorting mechanism of the K-shaped economy. Homeowners benefit from appreciation and fixed-rate debt. Renters face escalating costs with no equity accumulation. Institutional investors outbid individuals, converting homes into rent extraction assets. The result is geographic and class immobility reinforced by policy and market design. 7. Institutional reinforcement of the K-shape. The divide persists because institutions respond unevenly. Markets receive immediate liquidity support. Workers receive delayed, conditional, or temporary relief. Corporate losses are socialized. Household losses are individualized. This is not conspiracy. It is incentive alignment. Systems protect what they measure most closely, and financial markets are measured obsessively. 8. Why aggregate growth metrics are misleading. GDP growth, stock market performance, and corporate earnings no longer correlate with median household well-being. The economy can grow while life expectancy declines, debt dependency increases, social trust erodes. In a K-shaped economy, growth without distribution is extraction. 9. The long-term risks of a permanent K-shape if left unaddressed. The U.S. faces reduced consumer demand, durability, political instability, driven by economic alienation, declining innovation, outside elite enclaves, a generational wealth caste system. Once economic paths fully decouple, reintegration becomes exponentially harder. 10. Demand concentration. When the top 10% carries the economy, one of the clearest and most underreported signals of a fully formed K-shaped economy is who is doing the spending. Today, the top 10% of earners account for roughly 50% or more of total U.S. consumer spending, and by extension, a comparable share of GDP-driven demand. This is not a cyclical anomaly. It is a structural dependency. Consumer spending represents approximately 2/3 of U.S. GDP. When half of that activity is driven by a small, affluent minority, the economy ceases to be broad-based. It becomes top-heavy, fragile beneath the surface, and highly sensitive to the confidence and asset positions of a narrow group. Data aggregated from sources such as the Bureau of Economic Analysis and Distributional Studies, tied to Federal Reserve consumer surveys, show a stark reality. Lower and middle-income households are spending out of necessity, not growth. High-income households are spending out of surplus, flexibility, and asset appreciation. These are fundamentally different forms of demand. The collapse of mass market demand in a healthy consumer economy. Growth is supported by broad participation. Wage earners across income tiers increase discretionary spending gradually, reinforcing stability. That model is gone. For the bottom 60–70% of households, spending is increasingly absorbed by fixed costs, housing, healthcare, insurance, transportation. Discretionary spending is volatile and debt-supported. Any economic shock results in immediate pullback. This means large portions of the population are no longer reliable contributors to growth. They are economic pass-throughs, not engines. The luxury-driven economy. At the same time, high-end consumption has become disproportionately influential. Premium travel, luxury, goods, high-margin services, financial and experiential spending, entire sectors now depend on the spending patterns of the affluent. This explains a paradox often visible in economic reporting. Luxury brands report record profits. Airlines sell out premium cabins. Upscale real estate thrives. While, simultaneously, discount retailers struggle. Small local businesses close. Mid-market brands erode. This is not contradictory behavior. It is segmented reality. See why this is a systemic risk. An economy dependent on the top 10% for half its demand is not resilient. If asset markets wobble, interest rates rise, or confidence among high earners tightens, spending can contract rapidly. When that happens, there is no broad middle-class demand to compensate. The lower tiers lack surplus to step in. Recessions become sharper and more uneven. In effect, the economy has outsourced its stability to a narrow class of households whose spending is most sensitive to market psychology. D. The feedback loop that reinforces the K-shape. This concentration of spending power feeds back into the system. Businesses design products and services for affluent consumers. Wages stagnate further in mass market sectors. Investment follows margins, not participation. Policy responds to aggregate numbers that mask fragility. The result is an economy that looks strong from the top down, while hollowing out from the middle. E. The strategic implication: when only the top 10% are carrying half the economy, growth is no longer democratic. It is conditional. That condition is simple. As long as the affluent feel secure, the economy moves. When they hesitate, it stalls. That is not a consumer economy. It is a confidence economy, balanced on a narrow base. In closing, an economy balanced on a narrow base, the most persistent mistake in American economic thinking is the belief that time will smooth out divergence. It will not. A K-shaped economy does not self-correct. It compounds. When growth flows upward faster than it spreads outward, inequality is no longer a side effect. It becomes the operating system. The United States has reached a point where economic momentum depends on a minority. When the top 10% of earners generate roughly half of consumer spending, the economy is no longer broad-based. It is concentrated. And concentration is fragile. This structure produces the illusion of strength. Markets rise, luxury spending expands, aggregate numbers remain positive. But beneath those numbers, most households are constrained by fixed costs, debt, and volatility. They are not choosing restraint, they are absorbing pressure. An economy built this way does not fail all at once. It fractures in stages, first through declining mobility, then through political instability, finally through demand failure that no amount of monetary intervention can permanently offset. This is not a moral judgment. It is a structural diagnosis. No economy can remain stable when growth is driven by asset holders, while survival is borne by wage earners. No system endures when markets are protected with urgency, and households are stabilized only after damage is done. The K-shaped economy is not a temporary distortion. It is the logical outcome of decades of policy choices, incentive design, and institutional priorities. If the United States continues to measure success by market performance rather than household durability, the divide will widen further. And eventually, even the upward arm of the K will lose the foundation it depends on. An economy cannot stand indefinitely on its top rung. It must be carried from the middle. Until that reality is confronted directly, not rhetorically, not symbolically, the K-shape will harden, and what was once divergence will become permanence. Thank you for joining me once again on The Things That Bother Me. Please remember to like, comment, and subscribe below. Until next time.